Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Warren Buffett. Warren Buffett purchases equities only when he thinks he can obtain a fantastic firm for a reasonable price. He may acquire the most important businesses during bad markets for a discount. In his opinion, your life's most prominent investment chances present themselves at this time. Let's learn more about his strategy in this video. Warren Buffett bases his investment strategy on two factors: find great companies trading below their intrinsic business value and having huge discounts versus their future discounted cash flow. During extended bear markets, Buffett invests a significant portion of his substantial cash positions on the Berkshire Hathaway balance sheet in equities. He recognizes the value in pricing at this point. Warren Buffett doesn't always just invest in stocks. Only when a stock's price is in his perceived value range does he purchase a specific share. He won't purchase any stocks during overbought market bubbles, but he will begin to do so during bear markets, which are defined as decreases of 20 to 50% for stock indices and higher for specific equities. Based on the price of the company's underlying worth and cash flow, he wants to enter a position with a significant margin of safety. He seeks to maximize his upside profit potential while limiting his downside risk. He enters the market at a significant price discount at the ideal time, and if the fundamentals remain faithful, he'll hang on to a stock for at least 10 years or longer. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Warren Buffett. Buffett is a value investor, and his preferred time horizon is infinity. To carry out his investing strategy, he needs to purchase an outstanding firm stock at a reasonable price. He is transformed into a value investor seeking quality and development at the best possible price. What types of investment options exist? Investment opportunities occur when you have the possibility to purchase a product at a significant discount over its inherent worth. The finest possibilities arise when there's a great deal of panic in the market and sellers are willing to sell an item to you for little or no money at all. There's an expression that perfectly describes when to purchase cheaply at extremes. The time to buy is when there's blood in the streets. Baron Rothschild. Wars, recessions, depressions, and panics can produce once-in-a-lifetime investment opportunities in premium assets. Based on previous appraisals, great investment possibilities offer inherent value at a reasonable cost. It would be a low price-to-earnings ratio for the stock market, a reduced price in a developing location for real estate, and a high yield with a reliable bond issuer. Investment possibilities may be divided into two categories. Terrific investing opportunities do exist that have a great risk-reward ratio. Your upside potential reward is 3 to 5 times greater than the danger of loss, even if the chance of being incorrect is small. This type of investment has the potential to provide significant financial gains due to price growth from the purchase price. Outstanding investments reward you for long-term holding and ownership. An excellent cash flow from owning it was demonstrated by the other sort of investment possibility. This can be a security paying a high interest yield on a bond, a company with a high dividend yield, or a piece of real estate with a high rental yield. When you possess suitable investments, they continue to pay you. You can tell if an investment is excellent or poor by how much money you make or lose. Which investments should you make in your youth? Stocks and a personal residence are the finest investments to make early in life. A historical average for the stock market is 12% each year, and property prices often serve as a buffer against the inflation risk of rent increases while simultaneously generating capital gains. According to past experience, a 20 to 50% decline in the indexes is the ideal moment to begin investing in the stock market. Purchasing after the decline increases your likelihood of returns over the following year and bigger compounded returns over succeeding years. For long-term investors, dollar-cost averaging often works over 10-year periods and beyond, since the strategy involves the investor purchasing on the way down for lower and lower prices, and when prices inevitably rebound to all-time highs, as they always did in the U.S. indices. Buying and holding investors may benefit from earnings after market recoveries if they average into positions during downturn periods. Since 1926, there have been 14.7 years of bear markets and 75.4 years of bull markets overall. During weak markets, buy and hold investing offers the highest chance of success. When bull markets are coming to a close and prices stop setting new highs and finally fall, purchasing and holding investments carries the largest risk. The best investment opportunity a buy and hold investor will ever have is to purchase after an index has seen a 50% bear market loss. The best times to purchase in the 21st century were late 2003 and early 2009. If you are a buy and hold or value investor, there is a similar chance in the stock market right now for individuals who have the fortitude to look at history without being paralyzed by fear. That concludes today's video. Thank you for joining us till the end, and we'll see you in the next one. Goodbye.